What's up, everybody? Michael and Coco here. You're watching... Why? Why every time when I start a video? The Daily Stock Market Brief. Today's date is December 15th. We haven't showed our face, so we wanted to come on here and say hi. Interesting day in the markets. Boom, bada bing, bada bang. Most of them are up. Can't wait to get into it. Going to be looking over some charts, some indicators. Housekeeping though, if you haven't seen the interview that I posted earlier today with Michael Guyad, I'd highly suggest you go watch that interview. We talk about the lumber to gold ratio. It's a stock market indicator that he uses to determine whether he should be risk on or risk off when he is investing. It's a very good interview, and we're going to talk about the lumber to gold ratio a little bit in today's video. Without further ado, let's get into it. All right, welcome back. We're just looking at the indices right here. Green across the board. Holy moly. We'll get into the charts here shortly just to kind of see where everything is going. Let's look at the sectors though. What do you know? Energy is pumping the #1 spot right next to utilities. That's kind of interesting. Utilities catching the biggest bid here. Utilities are typically a risk off type investment. So maybe that's just an anomaly today. Maybe it's a sign of something to come. Energy, Yes, in yesterday's market brief, we talked about energy catching a bid or people buying up the pullbacks because its relative strength to the SPY, the S&P 500, it has been beaten down for quite some time. So that to me makes a lot of sense. The utilities sector doesn't make all that much sense to me. Let's look at the rotational graph. Now, this is relative strength, and we're looking at multiple different things. We're looking at small cap, mid cap, utilities, transportations, the NASDAQ 100 SP. It's all compared to the Wilshire 5000 Composite Index. All right, so we're looking at just an overall broad benchmark, and we're looking at the relative strength inside. You can see the rotations. You can see transports kind of going from what it was leading, now it's kind of weakening. They're still almost darn at an all-time high, but I wanted you to pay close attention to what is going into the leading section. We're looking at small caps and mid caps indexes going just driving straight towards the corner of leading. Now this is very interesting, okay? Because we already know that small caps have been in this very overextended move. And if you watch the interview that I posted today, you'll know that overextended can stay overextended for quite some time. And he also explains why small caps could be doing so good because of the current lumber prices. We'll talk a little bit more about that when we get into the lumber to gold section. Let's now jump into the S&P 500. On the daily time frame, yes, we had a pretty bearish looking candle, but mind you, what's going on around the news? A lot of talks around stimulus. We have the Fed coming out. It seems like they're trying to put together a deal for stimulus by the end of the week. So we'll see here if that actually holds true. But yeah, big nasty red candle followed by a big green candle. And it's back above the 5 EMA. It didn't hold there for long. This is typical. When we get below the 5 EMA, we see it ramp right back up. Notice the 20-period moving average kind of sloping up still. We came and tested it, acted as support. So now the bulls have charge of the 5 EMA, this horizontal line, this gap, and you have the 20-period all within confluence of one another. All right, let's look at the 30-minute time frame. 30-minute time frame. One thing that I want to point out here is, notice on today's gap, and then we started ramping up higher and then kind of consolidating. We did not make a new high from this bounce. So, you know, if we start rolling over, that's a failed bounce attempt. Now, if we start getting above that, then we have to start getting above this previous bounce. So right now we're putting in lower highs. Still have higher lows, but we have lower highs as of now, which that is what takes to change a trend. Don't hold too much weight on it. If we start breaking above 3,700, I'd say look at 3,750 or right around that range as a potential target. If you like these type of videos, go ahead and smash that thumbs up. Yeah. Let's look at the Dow Jones. Dow Jones on the daily, still. Okay, this is crazy stuff. The other day, we gapped up, right? And we ramped up higher, and then we just fell apart. Today, I mean, we gapped up a little bit, and then we just ramped up completely higher. So two very different dynamic days, and you can just see that this is just a bunch of chop. However, the upper resistance line is still being well respected. And we've seen this chart zoomed out more. This trend line goes back significantly farther than November. All right, if you just match it up, I don't have the chart on here, but it does. We're still within this range. The bulls have now charge of the 5 EMA. The 20-period moving average, tap, 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 3 taps. All right, so we have some support being held up at the 20-period moving average. We talked about this. If we start breaking above this, watch out, man. This thing could really start getting some stronger heat. To me, could be a consolidation for a higher move, but the consolidation to me is just not structurally sound just because of the higher lows put in place. I would like to see some more sideways action, but maybe that's what this is since, late November. Maybe that's what this is. Maybe it's what it's doing. And once we start clearing 3,200, then that's going to be that signal to move higher. We'll see. We will see. On the 30-minute time frame, just a very tightly coiled pattern. You can see just more data points, negative divergence in the MACD, negative on the RSI, failed attempt on this bounce to make a new high today. Maybe we'll clear it tomorrow. It's very hard to say. It seems like, what the Fed is going to come up with or what Congress is going to do this week is really going to determine the direction of the market. But lately it's been seeming like bad news is good news is good news, and, any news is good news, I guess you can say. This right here is the Dow Jones Composite up top, and then we have the three components that make it up. We have transports, utilities, industrials. First off, I want to point out that utilities have just caught a little bit of a bid, which to me is a risk-off move. All right, and we're seeing, typically what you got to see is all of these should move in unison with each other, okay? I have them on the area style chart. They all move up, and then they move down together. But sometimes when they start diverging for multiple weeks at a time, if not months, we need to start pumping the brakes a little bit because something could potentially happen. And we started seeing utilities here, why I highlighted in red, diverging, not making an all-time high. Meanwhile, the industrials, the transports, the DJA composite, all making new time highs. So this is just an interesting divergence taking place. Now we're seeing utilities catch a little bit of a bid here. Maybe there's more strength in utilities, and we're going to start seeing these rip down, kind of realign themselves, and then continue higher. It's too hard to say at this particular point in time. Just take note of the divergence. Let's look at the Russell 2000. Russell 2000. We redrew out this rising wedge. Still structurally sound rising wedge. Well, structurally sound, meaning a bearish structurally sound. We have all of these gaps that projected us forward. RSI is still very frothy. Just, it's the highest RSI reading, 76.5 on this chart, dating way back to, a few months. Way back when. Look where we gapped up at. We gapped up right around the 5 EMA. We tapped it. We pulled back a little bit, tapped it, and then we ramped up higher. We're at the upper range of the Bollinger Band. A little bit of a gap there, and then multiple gaps below us. It's very frothy, folks. Not the exact place that I want to go long. And then we have the 2-hour time frame. I redrew out the rising wedge here just to get it more into the pattern. You can just see more close up, the multiple gaps bringing this rising wedge up higher and higher. Notice the all-time high, 94.68. This thing looks like it wants to touch $200 in the near future. But it's going to get there by having some contractions and some pullbacks. So we've been technically playing this, I've been technically playing it when it hits divergences or extreme highs. So for example, right here, today I did do a short hedge position, very, very tight stop loss. I got out of the position. We'll probably see it gap down and go lower tomorrow, but I'll play it as time, kind of how it unfolds tomorrow. Negative divergence here on the RSI. Notice the high here and then a higher high. You got a high here and then a lower high. So we're making new highs on less relative strength here. Interesting. I mean, for what it's worth, but this thing keeps ripping higher, right? You know what? Actually, no, I'll talk a little bit more. Actually, no, let's talk about it now. So why are small caps doing so good? I mentioned that earlier in the video. We'll talk about why small caps are doing so good. And what was mentioned in the interview was, well, it makes sense that small caps are doing so good when you look at the cost of lumber. Lumber is meeting up with its September high. So it's been just on this rally rip higher. And the reason why lumber, can make sense for the small caps going up is because look at the housing index or housing prices, okay? So he says, I forget the exact number and watch the interview. I haven't done it already, but most people's wealth is tied up in their homes, all right? So when lumber rises, you see also the cost of homes increase. And when cost of homes increase, that domestically makes sense for small caps because we're talking about small caps, all right? So when housing prices and lumber prices get more expensive, it adds what I call, and what many other people call, I would consider it, the wealth effect. You start to see the value in your homes increase, which helps these small business owners because they can potentially take money out at very low rates to finance different businesses. Now, what I find even more confusing is most small businesses, restaurants, and many others have been closing like crazy. They've been forced to shut their doors, and now even if they reopen, it's still very hard to operate. So everything to me is just at this very, very interesting, really unseen point in history. So we'll see how it all plays out. But that was in the interview. He talked about why the small caps could be doing so good is simply because the prices of homes are just on this rampant rise for these last 2 months. Let's look at the NASDAQ 100. NASDAQ 100. Talk about some weird candle action these last 3 days. Yes, up in the last 3 days, we bounced from this area of support that we mapped out, 12,200, just above it. And then we had this hammer candle. Then we had an inverted hammer candle, which usually retraces. Now we have a hanging man candle. You can see how it gapped up, touched the 5 EMA, it acted as support. This is also a reversal type candle that followed from another type reversal type candle. So just some weird, strange action going on in the markets. We'll see how this one plays out. If we start breaking past this all-time high, maybe that's what gives us that extra strength to push even higher. If we do make a new time high, I don't necessarily know if it's going to be doing so on a negative divergence. So we'll see. But you can see right here, we hit the top band of the RSI right at 70. Then we started pulling back. And now we're starting to recover a little bit. We're not far off the all-time high. So if we make an all-time high and this doesn't tap out at 70, that right there would be a negative divergence. So we'll see. I'm thinking that eventually, if we do start rolling over, the 20 period can act as support, this can act as support, but it would be nice to come back and reconnect to the lower Bollinger Band and this kind of breakout area. If it does that, that could be a very good potential opportunity to hedge long. We'll see. Could continue. And then, what's interesting here is the 30-minute time frame. Now, I put this on Twitter earlier today, actually not that long ago, but we have a rising wedge and then we have another rising wedge. But what I want to pay very close attention to here, and by the way, this kind of looks like an island reversal pattern right here. You see how it gapped down, cleared, and then it gapped above, and we started ramping up higher. What I find interesting about this is, one, the pattern, rising wedge, rising wedge. But look at the ramp up today on the 30-minute time frame going to just the tightly coiled section of the rising wedge. This happened right here on the 8th. Notice how we saw that rampant run up, and then we broke down. Maybe we're seeing something very similar here take place. Maybe not. But you see that just big green move to the upside, and then we broke down, and now you see this big green move up to the upside. Maybe this relentless move higher might end up tapping out up here, double top, and then we start breaking down again. We'll see. It's too hard. You can't predict it, but we can be prepared for it. And we can prepare ourselves just by looking at this last time it happened. Okay, and the pattern and the price action. We can look at divergences and so forth. Let's look at the indicators. Oh, snap. What do we got here? The 10-period moving average of the CPC is moving up higher. When it crosses the red line, that is the quote-unquote sell signal. It's ramping up. Maybe it doesn't make it there. Maybe we're just a little bit of an uptick, and then we start heading back down again, and the bullish move continues. But as I see it right now, that was a pretty good little call out that we did with double bottom. When it reached here last time, we saw the market really rip down. And when it crossed above it, we saw the market kind of head a little bit lower there. Same with here. We crossed above it. We headed lower. Right now, as I see it, the market's trying to make all-time highs. And everyone is super bullish. Maybe if we cross above this, that's when the market starts to take itself a little breath, maybe fill some gaps. Maybe it's going to go into the new year. I'm not going to predict the time that it's going to happen. I'm just going to be prepared for when it does. Lumber to gold ratio. This is interesting. All right, so first off, if you want to learn about the lumber to gold ratio, once again, watch the interview. Okay, he is very brilliant, Michael Gayad, and I would highly recommend you just paying very close attention. I try to make some visuals on it to make it, at least for me, I can't just sit and watch an interview. I'd rather just listen to it on a podcast, but I try to add visuals into it with charts and movement and stuff to make it more appeasing to watch and just hold your attention longer, because there's some really good things that he says. I also put the timestamps in it. Okay, lumber to gold ratio. First off, negative divergence. He didn't talk about negative divergence or anything like that. I don't believe that he uses the indicator quite like that, but I want to call it out. Negative divergence on this. All right, we're starting to see gold move up higher. We'll get into the commodities. We're starting to see lumber go a little bit sideways, a little bit weak today. So yeah, maybe we're seeing it tap out right here, the lumber to gold ratio. He uses a 13-week rate of change. I'm using a rate of change for 3 weeks. We're looking at the weekly time frame. All right. The problem with a shorter time frame, as he mentioned, is it requires more trading. So you're going to be wrong more. You might be right more. You might get ahead of something big that happens, or you might have to just flip back and forth more frequently. So he uses the 13-week rate of change on one of his funds, and the 13-week change is pretty much just going straight up. He says he doesn't see him going risk off until probably the new year, most likely. Now, he also mentioned that a 3-week can be pretty relative, or work quite well too. It just requires more trading. So I put up the 3-week, and I just wanted to call out that, hey, it's actually been taking a little bit of a nosedive. So maybe when it crosses below 0, maybe we should be a little more cautious given the current sentiment of the market. Now, that's just me assuming. Doesn't mean anything's necessarily going to happen. I pointed out a couple times that it did cross over the 0. We saw that pullback here. Remember? September, boom. Right here, February crash, boom. But the 13-week did this too, and the 13-week did this right here. And then you can see all the noise crossing back and forth on the 3-week. On the 13-week, you don't see all that noise. So something to consider. Now let's look at the VIX. Big day, right, overall for the markets. Pretty solid green day. But what I find interesting is the VIX didn't really go down too much. That's an inside, pretty much an inside trading day. Okay, we had a big green day the prior day, hitting the upper Bollinger Band. Now we're getting a little bit rejected. Careful here because we crossed back below under the 50 on the RSI. So maybe this sets us up for another move higher in the markets. We come back and retest the lower Bollinger Band. That would put us at around 20, just below it. That's very possible. I can see probably some big funds thinking about that or hedging to this lower level right here. It would make sense to me, and I'm sure it's going to make sense to other people as well. Something to consider is just the fact that it was an inside trading day. And when these bands sometimes get tightly coiled up, we can see large moves very quickly. You saw that here. Tightly coiled up, boom, saw a move to the upside. Tightly coiled up, boom, to the move to the upside. Doesn't necessarily mean that it's going to go up, but it could mean that we have a big move coming, so be prepared for it. All right? If it does start heading lower, I'd say the lower Bollinger Band right around 20. I still have my original target at 27.50. I think we're going to be hitting it here in the near future. You know, what do I know? Let's look at commodities. This is getting interesting, okay? I think that gold was going to head lower when we got up here. And then for the last few days, trading days, I was like, it's not doing anything. But take note of the 200-period moving average. We basically tapped onto it is what I said. Now we're seeing some strength. 23 bucks up. That's a a dollar. Oh my gosh, I'm losing my mind. 1.27% up. And notice how it cleared these last 3 trading days. That could be an early sign of some strength coming in. I'm not going to get too excited about it right now, but if we start breaking above this trend line, we got to break above the 50. We need confirmation. But what's even more interesting is silver. Okay, these 3 trading days were very tightly coiled. So we have a 3-bar breakout. Yeah, 3-bar breakout. What you know about that? I don't even know about that, but that's what this is. You had 3 bars, basically chopped back and forth sideways. We had these little lower wicks, and then we have a breakout candle here. Sometimes on these moves, we get continuation. The only thing that can block us from continuation is this upper trend line. But if we start breaking out through that, hey, silver, and potentially even gold, can really start ramping itself up higher. So let's be mindful of that. Now, keep in mind, too, if gold and silver, ramp up higher and move higher, that can send the dollar lower. When the dollar goes lower, it makes gold more expensive. It makes silver more expensive. It makes commodities more expensive. Speaking of expensive commodities, look at oil. Oil keeps on pushing up higher and higher. In the video, we talk about this intermarket analysis between bonds and oil and how oil is a cost push inflation. All right, we're starting to see oil really break out. I think that we have some resistance up at 50. That would make sense to me just by looking at this pullback and an active support bounce, and then we broke down. So maybe we have some resistance up in this area. But right now, as I see it, we've been consolidating sideways. Looks like it's starting to move a little bit higher. We're seeing the energy sector. Really, those dips are starting to get bought. It's going to be interesting to watch this. But keep in mind, if oil keeps rising, that's eventually going to put pressure on multiple different sectors of the economy. So, think about it. Just think about it. Bitcoin. I redrew this out. I originally had a target right around the 50 period. We missed it about by 1%. Now look at it. It looked kind of like an ascending triangle. Maybe we still ping pong around and then eventually break out, but this is bullish. Bullish context, bullish pattern. We just need a break and hold above 20,000 to potentially move higher. This chop back and forth is probably just bringing the relative strength down. Now, the only thing is, if we start breaking out now to make a new all-time high, it's going to continue an all-time high on a negative divergence for whatever that's worth. All right, but keep that in mind. So it means we're going to be making new highs in the price action, but we're going to be doing so on less relative strength. Now, let's take a look at the dollar. Dollar bills, y'all. Falling wedge. Now, look at the price action. We're just completely getting hammered. Still a positive divergence as of now. On the RSI, kind of on the MACD. I'll give it to it. I don't know. Whatever. You be the judge of that. Still, we're below zero, which is bearish. The trend is bearish. The pattern is bullish. And we just broke through this 90-50 support level. We closed at 90.41. Maybe that's a temporary breakdown. We head a little bit lower and then break up. Maybe. Or this is just breaking down. And this is what's going to drive inflation. We have, obviously the dollar get weaker and weaker. We start to see commodities rise and get more expensive. We see the CRB rising. We see gold lifting. We see oil lifting. We see silver lifting. Well, we see everything just getting more expensive nowadays, don't we? And yet the dollar becomes weaker and weaker. Awesome. So that means basically anybody that saves dollars just loses money through this big transfer of wealth. It's just great. Now on the weekly time frame, let's zoom in here. So this candle here showed some strength. I talked about this as a potential reversal candle, but I said if we start closing below the previous low, that is weakness. We're there right now. We're below that low. So maybe if this continues down, the weakness continues. Now keep in mind, there's still a lot of support down in this range, and we're still in technical pattern. Positive divergence there. So far, there's still a positive divergence there. That might change, but as of right now, it's still there. So take note. If we start breaking out of this, that could send equities lower. That can send gold lower, silver lower, random other assets lower. It can send commodities in general lower. So just be aware that this is here. We're apparently looking for inflation. We want inflation. The bond market, which we'll get into now, has been technically pricing in growth and inflation. What do I mean by that? Well, first off, we're seeing bonds kind of just put in lower highs, lower lows, drifting lower. And you can hear more about this in that interview that I did with Michael Gayad. He can explain it a little bit better than I can. Then we look at yields. Yields have been just drifting lower. And I asked him, I was like, does this basically mean we're just pricing in inflation and growth? Yeah, but be very aware if we start seeing a sudden spike. And we've been struggling for the 10-year to get above 1. And the 30-year, you can see it's just putting in higher lows. We're putting in higher lows. The spread is widening, or steepening is what that's called. Oh my God, they call it steepening, flattening, and inverted. What I just call it, yeah, it's going up. All right, that's my brilliant mind at work there. Let's go into the conclusion section. All right, overall, strong day in the markets. The dips, they're getting bought. The gaps, they're getting ramped. How do you play this? Well, you got to play it very, very tactically. Tactical? You got to play it with tactically? I don't know if that's a word. But what do I mean? Well, first off, when you look at small caps on a monthly time frame, when I talk about overextensions, they're disconnected almost over 15% from the 5 EMA. All right, that's from the top of that's where the price action currently is. But technically, it was about 5 or 6% completely disconnected from the 5 EMA. You can see that on the 10-month moving average, or DMA, it's extended significantly. When you see these big aggressive moves, a reconnect is very likely. I wouldn't be shocked to see this reconnect to around 170, but when that happens, I don't know. But that could be a good buying opportunity if this trend wants to continue. We also have a negative divergence. So me personally, I'm not looking to go long right here. It sucks and it takes a lot of time, but I always like to remind people, the way down is significantly faster than the way up. I mean, keep in mind, these are monthly candles. 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, almost 9 months straight up. But 3 months brought us down to this low. All right, and if you look here, these 3 months down, just look to the left. Look how many months this was that it took out in just 3 months. So the moves down can be very aggressive. So if you are long right now, make sure that you're just very tactical about it. Buying on these specific dips or areas of support. And that's just how you have to play it. Even on the S&P 500. Look at this. Disconnected 6% from where the price action currently is from the EMA. And it's above the upper Bollinger Band as well. The MACD is darn near vertical. That's an aggressive move. Look at back here when this happened. We were a big green candle above the upper Bollinger Band. How did we finish? We finished with an inverted hammer, and then we had follow-through confirmation and smash. Same thing here. We got overextended and then we said smash. Over here, we didn't quite get as overextended where we are, but we got a little smash, right? So you got to be very just tactical around this. The next move on this S&P 500, if it continues this ramp up and builds up a longer upper wick, 37.50, or maybe we get another month like this. It's so difficult to play this, so you need to be patient with all of this is what I'm trying to say. And if you don't understand or want to put on like short hedges, then stay away from it. Maybe look at calls or, different sort of spreads that you can play if you know advanced options. You just got to be very careful, okay? You got to be very careful. And as Michael Guyad says in the interview, he talks about how he slows down for risk off and how he speeds up for risk on. So that's all I got for you on today's Daily Stock Market Brief. Thanks for coming in and watching the show. Yeah. Goodbye.